Okay, let's dive into a real market mystery. We're talking about Cintas, a company that by all financial measures looks like a Wall Street superstar. But there's a pretty shocking story hiding just under the surface.
So, here's the big question. How can a company the customers seem to absolutely hate be one of the best performing stocks you can own? It's a total paradox, and the answer reveals a powerful and maybe even risky business secret.
To figure this out, we have to start by looking at why investors love Cintas so much. And honestly, on paper, it really does look like a perfect business.
I mean, just look at these numbers. The story here is just relentless consistency. You see revenue and profits marching steadily up and to the right year after year. This is exactly what investors dream of.
And then there's this number, a return on invested capital over 25%. That is incredibly rare, and it signals that Cintas is a world-class machine at turning every dollar it invests into massive profits.
So, perfect business? Case closed, right? Well, not so fast, because the moment you look away from the financials and toward what actual customers are saying, the story completely flips on its head.
When you start digging into customer forums in the Better Business Bureau, you find this constant stream of complaints, and they all circle around one thing: these aggressive, multi-year contracts that are almost impossible to get out of.
And the result of all those complaints? A customer rating of just 1.15 out of 5 stars. I mean, that is a jaw-droppingly low score, and it just seems impossible for a company that's so financially successful.
This brings us right to the heart of the mystery. If customers are this unhappy, why in the world do over 90% of them stick around year after year? Well, the answer isn't what you think.
And here's the secret. Cintas's amazing retention isn't built on customer loyalty, it's built on customer captivity. The company doesn't have to make its customers happy, it just has to make it incredibly painful and expensive for them to leave.
You see, this customer captivity model is their powerful economic moat. But here's the thing. A moat that's built on friction instead of satisfaction is, well, inherently fragile.
And that's the big risk here. What happens when a competitor, an anti-Cintas, shows up offering simple contracts and great service? They could attack this one specific weakness and start to dismantle the very thing that makes Cintas so profitable.
Which leaves us with the ultimate question for any investor looking at this stock. Is this moat a durable fortress that will last for decades, or is it just a brittle house of cards waiting for the right competitor to come along and knock it all down?
But hey, this is just scratching the surface.